Well, good morning, ladies and gentlemen. Welcome again to the ConservativeHome marquee. I'm Mark Wallace, the Chief Executive of ConservativeHome. It's Tuesday, also known as Pony Day, because like me, everyone's a little horse. Sorry, not really that sorry. I've preemptively done what Theresa May didn't and opened a Strepsil on my desk, so there'll be no need to pass one out of the crowd, but please also don't give me a P45, which would be awkward. We're gathered now for a really vital discussion. I think ConservativeHome, in partnership with Phoenix Group, on the topic the investment Big Bang funding Britain's future. And as you'll all have seen when the rain isn't too thick, as you walk up to the Manchester Central building, part of the slogan looming over you is getting the job done. And that is clearly what the government is out to do. They're on the front foot now, trying to implement so many of those policies, making Building Back Better and levelling up a reality. And of course, the middle bit between an idea or a policy and bricks and mortar, new factories, houses, investment, infrastructure around the country actually taking shape, is the funding and where that money comes from. And that really is a vital part of what I think the government's announced in the last few months. We saw the investment Big Bang announcement by Steve in his previous capacity back in August. And we're here to discuss exactly how that initiative to unlock hundreds of billions of pounds of private sector investment in the infrastructure, housing and new industries that the country needs, how it can take shape, which bits of it are working really well, perhaps how it could be driven further, and how that initiative is going to help to get the job done. So we're very lucky to be joined by an august panel this morning, whom I'll introduce as we go along. But first, I hope you'll join me in welcoming the Minister, the new Chancellor of the Duchy of Lancaster, the former Chief Secretary to the Treasury, Steve Barclay.
Thanks very much, Mark. And good morning, and great to see everyone. And I think I'd sort of characterise it really in terms of the head and heart phase in terms of this agenda. The head bit is that you can't spend your way to net zero. You can't indeed spend your way to levelling up. We need to leverage private investment alongside the government spend that we put in, and the government can help facilitate that private investment, whether that is through the capital rules that are in place, looking at some of the Brexit opportunities around regulations such as Solvency II for the insurance sector, looking at the pension funds and how we unlock, if I take legal and general, 1.1 trillion of funds under management, how we unlock some of that in order that where we use the exchequer, we do so in a way that maximises the private investment alongside that. And that's what I characterise as the head bit. But I think there's equally an important heart bit, which is that I think for many people, they don't really think about their pensions until they come to retire. It's just something that gets handed over. And then at the end of their career, they then get their pension paid to them. And I think there's a real connection opportunity in terms of saying it shouldn't just be the Canadian pension funds, the Australian pension funds that are investing in net zero or investing in levelling up. We actually want to connect people's own money, their own pension funds, back into the investment, the long-term investment in the areas in which they live, in their place. And I think there's a real opportunity to galvanise the funds that are tucked up, particularly from a pensions point of view, and use that to unlock long-term investment, whether that's in net zero, levelling up, or the wider skills agenda. So that's the basis on which the Prime Minister, the Chancellor, wrote out to the industry in late July. There's going to be a further follow-up summit in the autumn. There's a huge amount of work with my former colleagues in the Treasury going on to look at how we get the right regulatory framework to do this. And when people talk about Brexit opportunities, here, Mark, is a clear example of that, where it's not about lowering regulation, but it's about tailoring our regulatory regime, our capital requirements to the UK market, the bespoke aspects of the UK insurance market, and doing so in a way that then connects to what are the people's priorities in terms of levelling up, net zero and so forth. So I think it's a hugely exciting opportunity. The sums that potentially can be mobilised are hugely significant. And also it shouldn't simply be the taxpayer that is doing these things. We should be mobilising that private investment as well. And that's the real opportunity we have before us.
Thank you very much. Now, our second speaker, Anthony Browne MP, is one might think of in some ways as had the career of a Renaissance man, really. Obviously, the high point of it was journalism. Personally, I'm biased on that. But he's a former economics correspondent of The Guardian. He's a former political editor of the Times, the BBC. He is a former policy think tank specialist, having run Policy Exchange. He's represented the British banking industry, and of course now he is a member of Parliament, and obviously is deeply invested in that role of kind of scrutinising what the government does, but also helping to urge on and sharpen what they do. So please welcome Anthony Browne.
Thank you. Thank you, Mark, for that generous introduction. I also sit on the Treasury Select Committee at the moment, so we do look at quite a lot of these different things. This is absolutely a critical issue, how we scale up our investment in the UK in infrastructure and also the green agenda, as Steve mentioned. It's been an ongoing issue for decades, and I think there is no silver bullet. But there's a couple of suggestions I think we can make, and it's been quite depressing actually seeing Steve mentioned the Canadian pension funds, but how many of our assets are actually funded by Canadian pension funds and Australian pension funds and so on. And I used to work briefly at Morgan Stanley, the American investment bank, and we had a big infrastructure fund, and they invested billions of pounds around the world, but actually not in the UK, which is quite humbling. I think there's several things we need to do. So one is, Steve mentioned one of the Brexit opportunities in Solvency II. This is, for those of you not in the insurance industry, this is the EU regulation on the capital that insurance companies and pension funds need to put aside. I remember when it came in, I wasn't directly involved with the negotiations, I did banking, but actually the insurance industry warned about its implications on lots of different things. It does need reform in a way that will enable pension funds, particularly defined contribution funds, to invest in new industries and also in infrastructure. So in South Cambridgeshire, I'm the life sciences capital of Europe, as I keep telling Parliament. So I've got huge numbers of life science companies, the global headquarters of AstraZeneca, that's the one that everyone knows, but I've got lots of smaller ones that raise hundreds of millions of pounds in investment. They're amazing companies. All their investment they go to America for. They don't get their investment in the UK. And part of the reason for that, there's two main reasons. One is that the pension funds aren't able to invest in these sort of companies because they're deemed too risky. The other is, and this is an onus on the industry actually, that they say the industry doesn't have sufficient analysts to actually understand life science companies and what's a dud and what works and what doesn't work. But in terms of the assets, so I work a lot with the Bioindustry Association, which represents life science companies. What they would like to see is a change of rules through Solvency II to enable them to invest in growth companies, but actually to do it through an aggregated fund, so to reduce the risk, so that actually a lot of the pension funds can come together, do it in a joint fund, and then spread the risk, but actually take an upside of the growth and invest in these companies that are growing so rapidly. There is another, on the banking side, I got very heavily involved with prudential regulation. This is the capital that the banks need to put aside to make sure they don't fall over. There are real restrictions on them being able to do long-term loans for infrastructure, like 30-year loans. You've got an infrastructure project that needs long-term funding. The banks are really restricted on what they can lend to that. And if we can, I think that there should be opportunities to actually unlock that a bit and actually enable banks to do more long-term loans. There is one other thing that I wanted to plug because it's a particular interest of mine. I wrote a recent article for ConservativeHome about it. You can watch it on the tax increment financing. Bear with me, it's a lot more interesting than the name suggests. So if you go to London, go and visit Battersea Power Station tube station, a brand new tube station that opened a couple of weeks ago. And it was a £1 billion investment, Northern Line extension. It's the first big expansion of the tube for decades. And when I worked for, actually one job I did, which you didn't mention, I think I worked for Boris when he was Mayor of London. I was in charge of economic development in London. And the Treasury wouldn't allow us to borrow the money for the tube extension, or give us the money for it, the £1 billion. So Boris asked me to come up with different ways of raising the money to £1 billion to build this tube extension. I look around the world for different models, and tax increment financing is this idea that if you invest in infrastructure, you often encourage economic growth to happen, and that leads to more businesses paying more tax to the Treasury. And so in Battersea in London, there's a whole area that has been derelict for decades, and no one had been able to build out the power station and so on, because there was no transport links. Nobody could get there or get to there or away from there. And so, through a lot of really painful negotiations, we had with the Treasury, we had reached a deal whereby the increase in business rates that new companies would pay there would be granted to Transport for London, and they could use that income stream to borrow the £1 billion to build the infrastructure in the first place. And the great thing about it is it doesn't require higher tax rates at all. It doesn't require more taxes paid from existing taxpayers. It's sort of future tax revenues. And if you have that, it's very common in the US, doesn't happen in the UK at all, apart from this Battersea thing. And part of the reason is because the centralisation of tax here. But if you have a deal with tax increment financing as part of it to de-risk it, then actually infrastructure funds are happy to come along because it takes away a lot of the risk and actually makes these projects a lot more viable. At least that's the experience in the US. So one thing I would urge is for the Treasury to be more open to tax increment financing. There's a whole load of reforms that they need to do for that. But I think it is a really exciting agenda. There's a lot to do, and I'm sure that the government, which has got this whole productive capital working group with a whole load of different proposals through the investment summit, will be able to make a big difference in this space.
Thank you very much. And for quiz fans in the room, Battersea Power Station being the only tube station with the word station in its name. Battersea Power Station station. There you go. Anyway, we've all learned at least one thing this morning. Here to teach us some more things, our next speaker, Dehenna Davison, will be familiar to all of you, not just the inventor of the Tory scum lapel pin badge.
More will be available this afternoon.
But not until I've got mine. Of course, famously, after the 2019 election, she and her colleagues with their blue scarves marched down that railway platform, having travelled down from the Tees Valley to help the Conservative Party take such a large historic majority. And when I mentioned earlier that question of getting the job done, it's constituencies like Dehenna's in Bishop Auckland, where I think the question will be asked at the next election when people step out of their front doors and look around, is my life materially different for the better as a result of the risk and gamble I took in changing how I vote? And so that, I think, is one of the ways that, in some ways, you're at the kind of tip of the spear in this topic. So over to you.
Well, thank you very much, Mark, and thank you everyone for turning out for what is actually a really vital discussion about our future and about how we fund our future. You're right, we did descend on Parliament wearing our blue scarves, and we did that for two reasons. One, because we thought it'd make a great photo and a memento for us, frankly, but mainly to really send a message that we were a united team of MPs, mainly newly elected MPs from the North East, who were really, really passionate about getting the most for our local area, an area which, by successive governments, has been a little bit left behind and a little bit forgotten. And that is where this investment agenda really comes in. And I want to talk a little bit about internal investment and about external investment. Now, I am no economist, so forgive me, but the thing that I find really exciting about the investment agenda are the real life opportunities that it creates for people. And I think sometimes we lose sight of that when we're talking about economic measures. We get bogged down in the detail without remembering to explain to people out there in areas like Bishop Auckland what it is going to mean for them and their everyday lives. Because at the end of the day, what is it that people want? What is it that unites everyone in this country, whether they vote Conservative or otherwise? I think it is that they just want to build the best lives for themselves and their family. They want to know that their children are going to grow up with the opportunity to have a great education, get a great job, and build a life for themselves and for their children, and that it's going to get better for future generations. And so much of that comes down to getting this investment in place. I think I'm really excited about our international opportunities, which some of these have come in this excellent, exciting post-Brexit age. But we've now got a government that's looking for investment through things like sovereign wealth funds. We have an announcement, I think it was last week, where £10 billion coming from a UAE and UK partnership, which is going to be money invested. There's going to be some coming to the North East through BP, which I'm very excited about because this is real jobs for real people, and that's what it has to come down to. And I think it is exciting now that we are able to look more internationally. You know, we've spent decades being tied up in EU regulation. Now we have an opportunity to really set a regulatory framework that allows, you know, our nation, our economy to really work for Britain in the best possible way, as Steve was highlighting earlier. But I'm also really excited about internal business investment. So taking aside major multi-billion pound projects, I'm excited about the investment that businesses are making to make themselves more productive so that they can employ more people. And I think one of the most exciting, sexy things that has been announced in recent times by this government is something that nobody else in this room will find exciting and sexy, but I really do. And this is a super deduction. There we go. We have a fan. You're the only other person I've met at this conference so far who has as enthusiastic a reaction as I do to this. But to give it a little bit of background, I used to work for an accountancy firm that specialised in research and development and advising companies on how best to invest in themselves and in their own productivity. And when this was announced, one of the lasses I used to work with sent me a message, and it was all capital letters, and it just said, yes, and a load of exclamation marks, because we know what this means. And for those of you who aren't familiar with the super deduction, I swear I haven't lit up like this since the conference started. The super deduction is effectively a way in which businesses can make savings against their corporation tax if they invest in things like plant, machinery, things that are going to really help them to become more productive. Because we know that we do have an issue in this country with productivity. We lag behind some of our European neighbours. We really need to make this better. So the super deduction, I think, is a great way, and this is me pitching to any government ministers who may be watching this panel to really extend it and look at making that a permanent feature of our economy for the future. So external investment, internal investment, I am very excited about our future. I am very excited that the government is talking about this investment big bang. So if any of you have got any contacts, any people you know who are looking to invest, the North East is a great place to come, so come and chat to me afterwards.
Thank you. If you weren't excited about super deductions before, ladies and gentlemen, I trust you are now. I'm going to say I personally very much am. And our final speaker, of course, while we're talking about what this money could do for people's lives and for the country and how the government could encourage it to be invested, the other part of the puzzle, of course, is the people who actually manage and administer that money, the people who are working with the government on the investment big bang. And our final speaker is for Mike Eakin, who's the Chief Investment Officer of Phoenix Group. If you think you have pressure in your day-to-day life, he's the Chief Investment Officer of a company with £330 billion under management, under administration. So here, please welcome Mike to explain to us from his perspective how this is actually all going to come together.
Well, thank you, Mark, and thank you for ConservativeHome for allowing Phoenix to come and join this illustrious panel to discuss the long-term investment needs in the UK. So as Mark said, I'm the Chief Investment Officer for the Phoenix Group. Phoenix Group, we're the UK's largest long-term savings and retirement provider in the UK. We've got about £330 billion of assets under management that we manage on behalf of about 14 million customers in the UK. And one of the big drivers for the Phoenix Group is to invest over the very long term, so to help our customers save for their retirement and then to give them an income in their retirement. So we invest over the very, very long term. When we take investment decisions, we think about a time horizon of 10, 20, 30, 40 years. And that really affords us to invest in heavy-duty infrastructure. One of the key investment hypotheses of the Phoenix Group is our view is that for too long, capital investment has been concentrated too much in London and the South East. Now, as we look at those 14 million customers that we have a financial obligation to help save for their retirement and provide them an income in their retirement, when we plot them on a map of the United Kingdom, unsurprisingly, they are not concentrated in London and the South East. They are diversified across England, Wales, Northern Ireland, and Scotland. So one of the big pushes that we have had in recent years is to really instigate a program of regional investment. And we think that's really important because we can invest in local economies over the very long term, building infrastructure, building housing where there's chronic shortages, and thereby producing jobs and economic growth. We are already doing this, but we really want to do more. And so the opportunity to come and speak at a panel like this and to get interaction is really, really key for us. So some of the investments that we've made this year in the midst of the pandemic. So earlier this year, we lent £80 million to Nissan's car plant in Sunderland. So Nissan could go and build factory production to produce electric vehicles. Now, from our perspective, that is a fantastic economic investment. It's a fantastic investment because it meets the obligations we have to our 14 million policyholders, but it also invests money in an area that has been chronically underinvested, providing jobs over the very long term and producing output that is highly sustainable in the form of electric vehicles. We are also very material investors in real estate and in UK housing stock. Again, we are of the view that there is a chronic housing shortage in the UK. We team up with numerous social housing associations to provide them financing so that they can build housing stock on a regional basis to try and bridge that housing gap. But to be frank, we're only touching the sides. We want to do more, we need to do more, and with the support of regulators and policymakers, we absolutely can do more. We take a very targeted approach to our investments, particularly around infrastructure and particularly around real estate. Fundamentally, our business is simple. We're a purpose-led organisation. For our 14 million policyholders, we want to provide them with a life of possibilities. So we invest on their behalf over the very long term. Another example of an investment we made this year, and we've invested right through the pandemic. We did not stop. We lent £34 million to Triple Point. Triple Point are a specialist provider of housing to adults with educational needs. Again, that was a fantastic investment because we could do it over the long term, it bridges the housing gap, and we're actually able to direct those long-term assets that we manage on behalf of our 14 million policyholders into a societal good. I suppose the ask from Phoenix Group is, continued support and engagement with policyholders, both nationally and regionally. We invest in local authorities. We want to do more of that. We want to broaden the networks of mayors that we interact with. We absolutely support the government's Big Bang letter. We completely agree. There is billions of pounds tied up on pension funds' balance sheets, on life insurance companies' balance sheets, that can be deployed in a manner which is positive for the customer, but has some really long-term societal benefits. So the key ask is not for this Big Bang letter just to be a Big Bang announcement in August and a summit later in the year, but is to follow on this and really make sure that the regulation, as the UK comes out of the EU, is fit for purpose. Now, at its core, financial regulation has to look after the consumer, and that regulation has to protect the consumer. We absolutely agree on that. But our ask would be to work with policymakers so that we can derive a regulatory rule set that goes to that aim of providing security to the policyholder, but allows the deployment of billions of pounds of capital over the long term to help propel the UK economy out of the doldrums that it finds itself coming out of the pandemic.
Thank you very much. Well, thank you to all our panellists for those remarks, kind of setting the scene. Now, I know there'll be a lot of questions from the audience. Anybody watching from home through the Conservative Party app, please use Slido to submit your questions, and they'll come through to me here. A couple of very swift, very polite ground rules. Firstly, please, when you get the microphone from my colleagues, say who you are. Secondly, if it is a speech with a few points rather than a question, I will reserve the right to boo you until you sit back down. Everyone's here to hear questions and answers, so please help that to happen. Let's see, the lady in the red coat here, please.
Vanessa Churchman, I'm a councillor, Isle of Wight. I sit on the pensions board. The LGPS, Local Government Pension Scheme, is the second largest, I think, whatever you call it, across the whole of the world almost, second only to the UK military. As a councillor on that committee, I have to think about my pensioners, so that's fine. How do we put together all the factors, ESG, looking after our pension funds, risk averse, which is a real problem, and it is a very difficult balance, but in my mind, my first thing is my pensioners. So how do we fit all these three things in? And the last thing of all, why on earth are we investing anything with a Chinese connection? Thank you.
So, two elements to that question. I think I'm going to bring in the Minister. I should say the Minister is with us, I think, until 11:45, so we'll try and fit as many answers from you as possible.
Thanks, Mark. Well, let me give two examples, and I think it builds on what Mike was saying earlier. First, to his point around where investments are being made, and I think what we've heard as part of the Levelling Up opportunity is the scope to invest in different areas. So we do have a concentration of investment in the south, and there's clear opportunities in other areas, including the northeast. And we see that with the link to other areas of government policy. If I think of our research and development, we're increasing our day-to-day spend from 15 billion to 22 billion. That is a huge uplift in our investment in R&D, and we need to think about how, alongside that, that investment drives scale-ups, startups and scale-ups, so we don't just have the research, but we then get the jobs and the innovation into the economy, and those are scaled up with investments such as from Mike's company on that. And then I think the second point to your question is that pension funds should be looking not simply at how we do more of the same, but how we deliver in a more productive way. So let me give you an example. At the moment, we largely build our housing stock in very similar ways to the Victorians, with bricklayers out in the snow and the rain. Whereas there's real opportunities, if we think of modern methods of construction, to use robotics, to use technology, to use automation, to then build with net zero and some of these other priorities factored in, to site those, often those factories in the northeast or the Midlands in some of these levelling up opportunities, and to build in a much more productive way. And I think one of the things we're then looking at from a government point of view, Mark, is how we combine the government's procurement power, whether that's on things like the Affordable Homes Programme or whether it's on the 40 New Hospitals Programme, how we use that commissioning power that we have as a government to then combine that with not the government paying for those factories, but the pension funds, the investors, investing because they have confidence that there will be a long-term order pipeline in place. And what's tended to hold back those investments has been a lack of certainty that the government would invest in modern methods of construction and use that on programmes like the Affordable Homes Programme suffice to justify that long-term investment in plant and machinery. And the investment, as we heard on the super deduction, again is a great incentive as a pensions fund as to why now, because actually there's some very strong tax levers to encourage you to invest. So there's a productivity opportunity, there's a levelling up opportunity, it allows you to invest in a way that is net zero compliant, but it also allows you to leverage the tax opportunity from the super deduction, which obviously has fiscal returns in terms of those you're representing.
And in the words of Donald Trump, China?
Well, China, I think, so one of the areas in terms of China has been looking at, I think one of the lessons from COVID has been how we get a better value around resilience in our supply chain. As the Chief Secretary, obviously, it's not a joy on PPE having to sign off inflated prices. But what is value for money changes at a time of national crisis, and if it's a question of getting the right supplies to our frontline NHS workers, of course we will pay more for that PPE because that value for money calculation changes. But what it does is show that through COVID, the importance of resilience in the supply line and thinking about what we want to onboard in the UK. And you can see that, Mark, in a number of the decisions that the Chancellor and the government has taken, not least in terms of fill and finish and some of the life science investment, whether that's in Swindon and elsewhere, and thinking about what we want to be able to procure from the UK and have that confidence in our supply. And we've seen that with the Pfizer investment most recently. So there is an adjustment in terms of what is value for money and what gives us resilience and what is critical to the economy, and therefore we've got to have confidence of supply.
And Mike, can I bring you in very quickly on this question from a local government kind of pension perspective? I think there must be things surely that some of these public sector funds could learn from what the private sector is doing.
Absolutely, and I thank Vanessa for her question. I think it's a great question. Like you, I go about my job, coming into my work every day, think about how am I going to look after the obligations of my policyholders as you do about your pensioners. And so the overlap is very similar. I mean, the way we think about it is in terms of risk and the risk that we want to take on behalf of our policyholders. If someone is 40 years from retirement, as a lot of people are, they can afford to take a very long-term view on their assets, and they can indeed afford to lock their assets up for a very long period of time. Whereas if someone is much closer to retirement, then they have a very different risk appetite, and we cannot lock their assets up for that period of time. So we take a very, very granular approach on what we do. Like you, also, one of my priorities is ESG. Yesterday, the Phoenix Group, the UK's largest long-term savings and retirement provider, we announced that for £250 billion of our assets, so out of the 330 billion, so 250 billion out of that, by 2030, not that long away at all, and it's mine and my team's task to deliver this with our colleagues, we will reduce the carbon intensity on that portfolio by 50%. Now that, in real terms, because I'm not a carbon scientist or a carbon economist, in real terms, that's the carbon emissions of 6 million homes in the UK. So if we deliver on this by 2030, we will have reduced the carbon footprint by the equivalent of 6 million homes in the UK. Now we can only do that, we can't simply sell those assets that are carbon high intensity today. We need to do this over the next 8 to 9 years. And we can only invest in new technology that's coming out. And again, one of our asks is to work with national government, with regional government, to invest in clean energy and renewable technology, those assets that we need in order to decarbonise our economy, that we need to decarbonise our portfolio and be good on the commitments that we've made. But the corollary to these investments is you're investing in new technology. That's creating jobs. It's creating intellectual property in the UK that the UK can then export globally. So again, one of our asks is to work with national and local governments to really focus the investments on ESG and decarbonisation because of some of the commitments that we have made as a corporate, but as the government have made nationally as well.
Anthony Browne.
Thank you. Your primary duty as with the pension funds is to look after your pensioners, obviously, and that's set out in law. But I just want to address this ESG issue, because it's great that companies like Phoenix are addressing it, but I think it's actually a really hard-headed thing. It's not like virtue signalling and doing nice things and everything else, although that's good. So the government's mandated this thing called climate-related financial disclosure. So this is all big companies have to set out what their risks are with climate change. And I'll give you real practical examples of what this means. Would you invest in a car manufacturing company that wasn't making electric vehicles when you know that petrol and diesel vehicles, new ones, are going to be banned for sale in 10 years' time? Would you invest in a gas company that's got a network across the country? I won't name any names, but actually if it didn't have plans for life beyond gas in terms of heating people's homes. These are company or an oil company that was made all its profits from selling oil when you know the demand is going to go down. Would you invest in all these different companies if they didn't have a long-term plan? So a lot of the ESG stuff, particularly it's really hard-headed, and it's actually, the structure of the economy is going to change. There are companies that are going to be winners and losers, and in thinking about the E in particular of ESG, it should help you guide the investments to those companies that will benefit from this transition to net zero, rather than those that will end up losing out.
Thank you. Now I'm going to bring in two questions and put them together. The gentleman here who was quick on the draw earlier, and do we have any questions on this side of the room? That gentleman there.
Mike Clitheroe, Billericay Conservatives. First of all, thank everyone for their very good feedback and presentations. On a lighter note, Dehenna, where did you get the badge and where can I find it?
Well, the badges were very cheeky. I was discussing this last week after Angela Rayner's comments and thought, we really need to reclaim this narrative. If we're going to get called Tory scum anyway, why not embrace it? So I was being a bit cheeky, joking, saying, I'm going to get a T-shirt printed for conference and just wear it proudly on my chest. I thought, even for me, in a bright orange suit, that's not very subtle. So I decided to get some badges printed up, which I was going to give to a few close friends. They disappeared within the first 2 hours because everyone was coming over saying, please, can I have one, including this chap who's first on the list. There are more arriving at my hotel anytime now, and I will be around. So if you can come and find me, Mike, then you're very welcome to one.
I'd like to get hold of some. I think my group would love those.
No problem.
Thank you very much. And
Entrepreneurial spirit.
Of course.
it should be on. Give it a go. Yep.
Hello, Jack Richardson, Melson and Rutland Conservatives. There's something for the MPs on the panel, and Michael, if it's something you know about. But your colleague John Penrose wrote in a piece in Britain Beyond Brexit, calling for the UK to establish its own sovereign wealth fund. I'm just interested to see hear what your views are on that.
Great, and let's bring in a second question to pair with it. The gentleman here at the front, please.
Thank you very much, panel. Sam Johnson, I'm a strategy consultant at Boston Consulting Group, and I was formerly an infrastructure lawyer at Freshfields. My question actually follows up to an extent on what Vanessa has raised, because I think it's a super important point. China has perhaps embarked on the largest infrastructure investment program in history in the last 10 years as part of the Belt and Road Initiative. Specifically in respect of infrastructure investment, not supply chain, to what extent should Britain regulate Chinese investment on a national security ground into the United Kingdom?
Two fascinating questions there. Dehenna, can we come to you first?
Yeah, of course. I think to an extent there's a way to actually tie the two together. I'd certainly be up for the UK looking at creating its own sovereign wealth fund. We can do great things around the world, and it's a great way to show the power of Britain in helping other nations, building infrastructure and really improving the lives of people in some of those third world nations that really need that investment. And I think this is where it ties in to Sam's question there. If there is an alternative to Chinese investment available to some of these nations that so desperately need investment, I would rather Britain be playing a part in actually providing that, either through providing our own investment or by working with other partners to help show that China is not the only available answer. There are other nations that would be willing to come here who frankly have a much better track record on things like human rights.
Steve.
Well, firstly, we already look at it from a national security point of view. Secondly, I think there's a balance. We want to be attracted to inward investment. We want to do so, obviously, in a secure way. And that's why we've set up the Office for Inward Investment through Jerry Grimstone. And that's about building on the strategic opportunities that we've got. So the mention of sovereign wealth funds, we've got £1 billion in terms of the UK United Arab Emirates sovereign wealth fund partnership that is going into the life science sector, and there's a huge amount of work that Jerry and that team is doing. But ultimately, we're a party that is pro-business. We want to be attracted to inward investment, and we don't want to rely on the taxpayer to always be the one we're turning to fund that. So we've got to attract inward investment in, but you're absolutely right, do so in a way that is secure.
Mike.
Yep. It's beyond my pay grade to say whether a sovereign wealth fund is a good thing or a bad thing. My personal views, I think it would be a good thing. But what I would say is, from my perspective, is don't lose sight of the prize and the opportunity that is here and now. There's £2.1 trillion of liabilities and assets sitting on UK private sector balance sheets in the form of their defined benefit pension schemes. Tap into that. I mean, a sovereign wealth fund it's not like buying an Apple iPhone. It's not plug and play. You'll have to go and build it and hire people and get it up and running. Whereas right now, right here, there is tens and hundreds of billions of pounds that are locked up in pension schemes, in life insurance companies, that can be deployed for the good of the UK economy over the very long term. So I'm supportive, but I would say don't lose sight of the prize, which is the here and now.
Thank you. So on the Sovereign Wealth Fund, although I admire and like John Penrose an awful lot, I'm actually sceptical about the idea that the UK should set one up. So when often people write into newspapers, I say this as a former journalist, saying they've got a bit of savings, where should they invest it, here, there or the other? And the best advice is, if you've got a mortgage, actually just use your money to pay off the mortgage before you start saving up. We have a huge national debt in the UK. It's now about 100% of GDP, although you can have a debate about that. So you should only set up a sovereign wealth fund rather than pay off national debt if you know that you can invest it in a way, and you're guaranteed to invest it in a way that will provide better returns than paying the interest on the national debt. Interest rates are very low now in the UK. The serviceability of our national debt is at historic lows, but interest rates will go up. Every 1% increase in interest rate means we have to pay £25 billion a year more in interest. That's your CSC. What's 25 billion? The entire police budget or something? Something like that.
Well, it depends, because actually the police budget is 2/3 government, 1/3 local council. So
right.
It depends.
Yeah. Right. But I mean, so if interest rates go up by 1%, that's 25 billion extra. So if you put money in a sovereign wealth fund rather than pay off national debt, you've got to be really sure you're going to get a good return on that. Is the government that well placed to be able to know that it's going to get really good returns? I'm half Norwegian. Norway has got the biggest sovereign wealth fund in the world. But the reason why they've got the biggest sovereign wealth fund in the world is they have this huge budget problem every year, which Steve never had to face at CST, is what do they do with their enormous government surplus? You know, they've got far more, because of their oil revenue, second biggest oil exporter in the world after Saudi Arabia, only 5 million people. What do they do with it all? And they've paid off their national debt, nothing that. They just stick it in a sovereign wealth fund, go and buy up, I don't know what it is, like 1% or 4% of the stock exchange in the world is owned by Norwegian government. But that's just because they've got all this money and don't know what to do with it. So anyway, that's my caution about the sovereign wealth fund. On China, I'm, I think, along with Dehenna, we're both on the board of the committee of the China Research Group, which is arguing for a sort of realistic policy towards China, I should say. So I do feel deeply nervous about the idea of China building nuclear power stations in the UK. Is there anyone here who doesn't feel nervous about China building nuclear power stations in the UK? No hands? Yeah. Yeah, there's one stage where they're investing, then another stage where they're building. Anyway, we do have to have a hard-headed approach to national security on those issues.
See, it must be really boring being the chief sec in Norway, Steve. You've had an exciting time.
It sounds a nice problem to have.
The spending review of Norway must be a very dull experience. Let's find a couple more questions. Do we have any female questioners in the room who'd like to ask a question? No, not as yet. Oh, lady at the back there. And then I think there's a gentleman sitting in front of her as well. I'm not woke, merely ConservativeHome is the home for all Conservatives, as it should be.
Hi, it's Anne Fairweather from Hargreaves Lansdowne, and I feel very sorry for my colleague Nathan, who sat on the Productive Finance Working Group. But we're obviously particularly interested on the retail investment side of things. We've got 1.6 billion clients, and clearly for some of them, there will be opportunities here. So I think obviously there's a big question there on levelling up and where the investment goes, but I think there's also a question for the Conservative Party around retail investment, and do you want individual people to have a stake in these long-term funds? Because some of them will be looking for a self-invested pension, for example. We wanted to get those long-term returns. And so how do we create a financial regulatory environment where people with wealth who do want to invest in this country have that opportunity?
And was there, I think there's a gentleman sitting, there we are on the back row, sorry.
Good morning, Nathaniel from FTI Consulting. My question was going to be sort of aimed at Phoenix, I suppose, but anyone else can answer it. How do you ensure that people or funds that are decarbonising their investments or moving to more sustainable investments aren't simply shifting the less environmentally friendly investment opportunities or companies to other investment funds? And so it's sort of like similar to carbon offshoring, whereby we don't burn coal in this country, but the coal is now burned elsewhere. So it's a bit misleading. How are we ensuring that's not happening?
Thank you very much. Steve?
Well, I think firstly one of the things that helps around that is more transparency and disclosure. So it is clear what is being done with investments and the disclosure requirements that apply to companies around that. I think to the point on the retail investor side, I'm a sort of former financial regulator, so at one stage in my career, as so often with retail financial policy, it's the devil's in the detail. So do you want to encourage it? Yes, you do, but you want to do so in a way that is proportionate and addresses the mis-selling risks from a conduct of business perspective. So the devil is in the detail, and that's why having the working groups, which you've been so helpfully contributing to, is so important, because it's how we design that in a way that strikes that right balance.
Dehenna?
Yeah, I mean, I think Steve's hit the nail on the head, which kind of makes a lot of sense given that this is your direct ministerial responsibility. That transparency is key when it comes to investment. So transparency and accountability, and the fact that there are so many kind of levers and mechanisms in place to kind of check up on this. The government's doing an awful lot of work through the working groups, and that's about it. My expertise is not stretched for me to give much better an answer, I'm afraid.
So on that point, the CBAMs is the answer. That's carbon border adjustment mechanisms, payments. So I completely agree. It would be absolutely wrong for us to tax or impose restrictions on our steel industry just for it to all close down because it's too expensive, and we just end up importing from other countries where they don't have the same controls. It will do nothing for our steel industry and our jobs in the north of England. It will do absolutely nothing for the climate, because actually we'll just be exporting production to countries that don't have the same net zero objectives as we have. And so the intellectual potential answer to that. It's something the government is looking at, but it's very difficult to achieve, which is actually basically tariffs on imports that take account of their carbon production, as it were. So that if another country, I won't name any names, but if they want to produce steel without any sort of net zero ambitions and restrictions, and they can do it really, really cheaply as a result, but they're polluting the atmosphere, then we could impose tariffs on those steel imports so that our steel industry isn't undermined, and in fact that actually the efforts of those countries that are trying to reach net zero aren't undermined by imports from those countries that aren't trying to reach net zero. There is a huge sort of consensus that these carbon border adjustment payments are the way to go, but very, very difficult to achieve because they require global coordination and agreements, and across lots of different sectors. You can start with one industry and then sort of widen it out. But the government is theoretically supportive. The EU is supportive. Joe Biden is supportive. But actually trying to get it done, that'll take some time.
And Mike.
Yeah, so I think two great questions. I think first going to Anne's question on the regulatory regime, I completely agree with the sentiment you're making. We made £100 million allocation to venture capital earlier this year, £100 million going into UK startups, VC. Frankly, the brain ache that was required for us to make that investment, it would have been just easier for us to invest £100 million in the S&P 500. We could have done that in a matter of minutes, not the number of months it took us to get that VC investment through. It was critical that we made that VC investment because these VC investments are helping early stage companies in the UK who are disrupting existing industries and creating jobs and creating green technology. So we felt passionate about it and we went through and got the brain ache. But completely agree, the regulatory regime has to have the consumer at its heart and the protection of the consumer at its absolute core, but then needs to be fit for purpose to allow these other investments. So the gentleman from FTI Consulting, apologies, I didn't catch your name. I think it's a great question, a really great question. And I'd say two things on that. One, there is the Task Force for Climate-Related Financial Disclosures, TCFD. We are a signatory to that. We are going to be adhering with that as per the requirements, for our future annual reports. As you would expect of a FTSE 60 company. But furthermore, the companies that we invest in, we will also require them to be able to produce their financial reports in a way that is aligned to TCFD, that gives us, the investors, the insight and the detail and the clarity as it relates to their carbon emissions. And I think the final thing I would say on that is around stewardship. So as we mentioned, we look after £330 billion of assets. We have a dedicated head of stewardship, Valeria Panini. She's got a fantastic job. And her job and her team's job is to engage with companies first. We really believe in a policy of engage. And this engagement will take place over months and years. But ultimately, if we feel that the companies that we've invested in are not listening to us in terms of our requirements, in terms of decarbonisation or the clarity of their financial disclosures, we have the ultimate sanction, which is divestment. And when you turn up to a CFO and you say, we manage £330 billion of assets, we want to talk to you about the clarity around your carbon emissions, unsurprisingly, they tend to take the meeting and share the information that's required.
Thank you. Now, as I mentioned, Steve has to leave us in just a moment. He's being generous with his time, so we have time for another quick question. Then we have the rest of the panel staying with us. So let's see, show them. The gentleman here at the front, please.
Brian Stevens from Kensington. I've worked in finance technology for 20 years, and I've seen us essentially shift jobs out to far-flung places, be it India, Philippines, or what have you. I think we need to, obviously, whilst that's attractive in trade deals and what have you, to actually build relationships, I think we need to readdress some of that balance. How do we incentivize companies to actually create technology centres in places like Bishop Auckland, and as my company grows, hopefully I can create an office there as well. But I think we need to create incentives to allow companies to actually grow out technology centres here rather than actually just pass it off to other countries.
Steve, in an age of global Britain.
So firstly, I mean, we're a global leader on fintech. If you think of the financial services sector, 2/3 of those jobs are actually outside of London. So when I was the financial services minister, used to be called the city minister, which is slightly misleading because actually a lot of the jobs, including Manchester, Edinburgh, there's lots of other areas. I'd slightly take issue with the fact that every area should become a financial services area. I think one of the things we need to do is build clusters of expertise and different sectors. I think of Ben Houcham and Teesside and how he's leading on areas like net zero. I think different areas will have specialisation. I don't think every area, one should sort of spread the jam so thinly that every area is trying to do everything. So we should build those clusters. I think I'm more positive than perhaps was inherent in the question. If you think of our approach to high-skilled visas, where we've said on that actually we want to attract talent from around the world. We want people to come and work in our sector. I'd look at the work that John Glenn has done, hugely experienced, longest serving financial services minister, very respected, I think, in the industry. The work that John has done on the fintech bridges, working with Australia, Singapore and elsewhere. And then obviously the trade deals we have. Often the debate when I was Brexit Secretary was often about the status quo areas of business. And I think one of the most exciting opportunities for us to get our regulation right, but also to look at innovation, is to think of the growth areas. So in terms of today's topic around green finance and how we better connect the expertise we have in the UK in some of those growth sectors. We've got the industrial strategy areas like AI and how do we get the right regulatory framework in those. So I think there's huge opportunities, but what business often said to me was, firstly, we want to attract talent. So let's ensure that the high-skilled labour can come here. Secondly, let's go after the growth opportunities in areas like fintech, and then do so in a way that builds clusters of expertise. And within the Cabinet Office, one of the things we're doing is then looking at the number of civil servants in London. How do we actually, through the Places for Growth, move more decision makers closer to those sectors across the UK, so that we have more BEIS officials up in the northeast, or in the Treasury's case, we have Treasury officials in Darlington, so that those making decisions on policy are more closely aligned with the communities that are affected by those decisions.
Thank you. Mike, as from the investor and employer perspective.
Yeah, absolutely. Look, I think, Brian, it's a great question. We are significant investors in UK universities. So we lend to universities, including universities in this great city. And when we have discussions with universities, one of the things that we're really keen, to go to your point, Brian, is you have great intellectual firepower being developed in places like Manchester and Leeds and other places. But one of the issues is that when this intellectual firepower is developed, when people graduate, when they do their degree or when they finish their PhD, they leave and they go to London or they go elsewhere. And actually, going to, I think it was Steve's point, what you need to do is create centres of excellence and create an infrastructure that people can really excel in their career and want to stay in the regions where they've learnt their trade and developed some of that intellectual technology. So our key focus there is continuing to invest in universities, again, long-term financing, and really working with them to understand that when they develop this talent, what's their policy for helping the talent be retained in the local area, in the areas of excellence that those universities have?
Anthony.
Thank you. It is indeed a very good question, and I wouldn't want to say to companies that they can't use the skills of people overseas if they can get the talents. I've been on the board of various companies. I did a lot of work in financial technology, which use people in Eastern Europe or India or Malaysia. But I think the answer really is skills. I mean, I totally sympathise with your premise that actually we should try and keep as many jobs here. And there is a real shortage of, as I'm sure you know, of IT skilled people in the UK, and so that is getting a lot more training, and Steve touched on this, links up with universities, more apprenticeships. The government announced yesterday 2,000 scholarships for AI, for artificial intelligence. In fact, some of the companies I was on the board of were focused on artificial intelligence and actually used programmers in India because they couldn't do the neural networks and everything because they couldn't get them here. So if we build up those skills here, then hopefully companies will be able to find the staff here and keep the jobs here.
And Dehenna, just to kind of develop this question a little further, when you have some parts of the country which have suffered in recent decades partially because of the predominance of and reliance on the industries of the original Industrial Revolution, how do we kind of make sure we're getting some of the security and resilience of kind of diverse economic recovery through diverse industries, but still trying to get the cluster effect? So how do you manage to do
It's a
both?
difficult one, Mark, to be honest. I'm just going to come back to a point Anthony made, and then I'll come on to that. Just as you were saying your sentence about how it comes down to skills, I'd literally written the word skills here. I'm
great
glad
minds think alike.
we're right on the same wavelength. I think we do have a massive issue with skills in this country. Something the government is addressing. We've got the lifetime skills guarantee. We've got T-levels. We're looking towards university technical colleges. Because I think we recognise that education isn't working for everyone, and that we do need to look more towards some of these tech-savvy sectors, look more towards coding, digital, just general computer science, so that we know we've got people with the skills we're going to need as we develop into a more kind of technological economy. So I think that's really crucial. And we've got a great UTC in Sedgefield, which is going to start actually taking on Year 9 students as well. They have great links with business. And I think it's one of these things that shows how an incredible partnership between the public and private sector can really work. And I'm hoping that in the coming years we'll really start to see that working as we see these kids getting into those jobs and really helping show we do have a skilled workforce here in the UK. Your point about resilience, Mark, is it's really difficult. You know, parts of the world like mine, either where I grew up in Sheffield, which was so heavily reliant on the steel industry, or the northeast. I mean, my patch in Bishop Auckland, it was all the railways and it was mining. We don't have that these days, and so we do have to look towards the future. And I'm actually really optimistic in two ways. Firstly, in terms of the manufacturing that we know we can do. So Nissan was mentioned earlier on. We know the Northeast, we know how to make cars in the Northeast, we know what we're doing. But of course, we know also that transport is moving towards a much greener and leaner focus on that sort of technology. So we need to embrace that, and that's absolutely what's happening. So seeing the £1 billion investment in Nissan in the Northeast to actually develop battery tech and make sure that we are making the vehicles fit for the future that people are going to want to buy is really important. So we're still doing manufacturing, but we're doing it in a really exciting and innovative way that's really fit for the future.
Thank you. Let's see if we can get a couple more questions from the audience. The gentleman here and the gentleman here.
Before you start, Brian, if you do open up a new office, come talk to me.
So, George Braid, I'm a control room operator at Hartlepool Power Station. So following on from what you guys have just said here about investment in skills especially, and in this expertise that we have, particularly in the northeast but other areas of Britain as well, I'd like to ask the panel, what plans are there currently, in addition to what you've mentioned about Nissan in Sunderland, to really unlock the full potential of workers that exist already in the northeast, who already have the skills and are ready to go? Because admittedly, in our power station, there are several people who are retiring right now. But there are also people my age, quite a bit older than me, maybe mid-40s, who are looking for another lease of life after this power station closes. So I think that's an essential part of our recovery. So I'd like to ask the panel what investment opportunities you foresee in areas such as the northeast, which, as we described, have been left behind in recent years.
And a question here.
Nicholas Beale from Hammersmith Association, but I'm also a strategy consultant in real life. Absolutely agree about the super deduction. That's a great carrot. UK businesses have been terrible at underinvesting in innovation, skills, capex, and they've been spending many, many billions on share buybacks, about 8-10 billion a year. One of my most depressing conversations was with the CFO. He said, "This is a great innovation, but I can get a guaranteed return by share buybacks. Why should I do it?" Could we, as a little bit of a stick, put the health and social care levy on share buybacks? Because we put it on dividends, we haven't put it on share buybacks. It's a terrible thing. Frankly, companies that do share buybacks are admitting they've got no idea what they should be investing in, but maybe we should give them a little bit of a prod in the right direction.
Mike, can I put those questions to you?
Yes, thank you. Look, two great questions. I think, George, firstly, in response to your question, I completely agree. We need to invest in a way which the labour force can reskill and retrain itself. And for us there, a key area is investing in technology and investing in green technology. We're super excited by the opportunities that are presented there. If we think about the path to decarbonisation, we can't get there by just divesting of assets. We're going to need to invest in new assets that enable an economy that reduces on a much lower carbon footprint. Technologies like the production of clean hydrogen, which we're at the really, really early stages of. And again, the technology and the intellectual prowess the UK has tons of, but we just need to harness it. The second around carbon capture. So, economies produce carbon, but then the carbon is captured and it's stored safely. So at Phoenix, we invest over the very long term to provide our customers with a life of possibilities, and we do that. And in doing so, we want to invest in local infrastructure and local technologies that will enable those new technologies that will help retrain and reskill a workforce. I think George, George, hopefully that answers your question. We're very committed to that. Nicholas, thank you for your question. I actually live in Chiswick, so maybe I'm a member of the Hammersmith and Fulham council taxpayer. So thank you for your question. Look, on share buybacks, I'm not American, I'm Irish, but I'm going to plead the fifth. I'm going to allow the legislators to talk about that. What I would say is, the UK capital markets regime is very, very attractive, right? It's attractive for investment, within the UK, but outside investment. I think when you start to curtail some of the tools that companies have in terms of, managing their capital stock, on a marginal basis, you reduce that attractiveness. Now, I'm not saying if your proposition was put forward, that would stop non-UK companies investing in the UK. I'm not being that dramatic, but I just think that's something that we need to be aware of. But I'll let the legislators opine on that in more detail.
And the hot potato rolls along the counter to Anthony Browne.
So just on the northeast first. So I'm not. Dehenna can talk far more about the north of England than I can. But I actually wrote down carbon capture and storage before you even said it. But, so I think there is I'm chair of the All-Party Parliamentary Group on the Environment, and I'm a big fan of these new technologies such as carbon capture and storage and hydrogen. And there clearly is huge opportunities in the north of England for that, because a lot of the skills that the people that you're talking about are relevant for these new technologies. But they are early days, and we do need to invest in them. And the key thing is to make sure the government has it as a priority for, as the Prime Minister keeps saying, one of the things about levelling up is making sure people can work where they want to live rather than have to move to where the jobs are. So in South Cambridgeshire, we're a real hotspot for jobs. We've got huge private investment. I've got the global headquarters of AstraZeneca's just being opened up next month, and we've got 0.3% unemployment, completely full unemployment. We have lots of people moving to us. The people in South Cambs don't like all the house building that goes along with that, I have to say. From my constituents' point of view, levelling up means people should be able to have more opportunity to work where they want to live and not feel they have to move to the other side of the country. On share buybacks, your specific question about national insurance contributions on share buybacks, that's an interesting idea. That's really quite a technical thing about how that would work. So I'd have to take that away and look at it. But I agree. Yeah. There's all sorts of issues about stamp duty on share buybacks and so on and so forth. But the general issue about share buybacks, so I think the fundamental problem there is, and apologies to the sponsor here, but the fund management industry in the UK, for all sorts of very profound structural reasons, tends to think, and you'll probably disagree with this, but tends to think far too short term, and it's very difficult for them to take a really long-term view. That's why I welcome you trying to take a really long-term view. But actually share buybacks, they instantly boost the share price and suddenly you get a good return at your next quarterly announcement and say, well, that's wonderful. But actually the long-term productive investment of the company is sacrificed as a result of that. And I think we need to have a big, long think about how we get the fund management industry in the UK to have incentives to think about the 10-year, 20-year, 30-year impact of their investments rather than just trying to buy back a bit of the company to get a boost for the next month.
Sorry, without a microphone, the viewers at home can't hear you, so it ends up as a one-sided.
He was agreeing with me, viewers
excellent.
At home.
Yes, it was applause almost as enthusiastic as that for the super deduction.
So Nicholas, I'll come to your question first, and I will be completely honest, share buybacks are not really my bag. But in terms of the health and social care levy, I mean, I'll take the stance that I took actually when voting on this, in that I don't actually want to see more taxes. So I would rather us use the carrot approach much more than the stick approach, which is why I'm so pro super deduction and would really like to see it extended beyond the scope of the next 3 years. So that's one of the things that I'm pushing for with government, so wish me luck. But I think this point about business investment, we really need to look in much more detail about how we really try and drive up productivity. Now, we talk about it, and politicians of all colours talk about it, but I certainly haven't seen any real productivity drive, something that we talk about in enough detail to really get the public on board with this. So I'd like to see that, because it is absolutely vital for our long-term prospects. And I'm talking about economic prospects, but as I said right at the beginning, it's what that means for real people. You know, high quality jobs, people having more opportunities to get on. That means businesses do need to be investing and innovating and making sure that they're setting up their future, not just looking at profits, but looking at actually how they can contribute to their local economy and to the national economy too. And on those investments, I think we often talk about this in terms of kind of plant and capital, as I mentioned earlier. But I think sometimes businesses are not very good at investing in their workforce. And this comes to your question, George. George and I are sort of from the same association. He's a good egg. Definitely. But you're right. When it comes to nuclear in particular, there are some incredibly highly skilled jobs there on the power stations, and there are sort of less highly skilled jobs on the power stations. I think for you guys who are in those highly skilled jobs, the transferability of those skills is fantastic, which means that, you know, once that power station closes, you're going to have a really bright future ahead of you because you can turn to some of these new technologies. Where my concern is on the people who don't have those high skills. It's the sort of labourers closer to the bottom end. And that's why I think, as I pitched earlier, the lifetime skills guarantee from the government is going to be vital, so that people in their adult life, if they want to, if they choose to, really can retrain. Because I think that's something where in the past, it's sort of been looked upon sort of a little bit lowly, like, oh, going back to college as an adult, no, this is great. Why shouldn't you go and retrain, learn new skills, move on to a new career? I mean, it's fantastic. We want to be encouraging aspiration. We want to be encouraging people to move into new sectors and take big, bold steps. And I think that's how we're really going to get our economy moving for the future.
Fantastic. Now, a couple more questions on him. The gentleman there has been extremely patient, as has the gentleman here in the blue tie and the glasses.
Good morning. It's Ian Ray from Southwest Herts, but I'm speaking as a retail investor. There was talk some time ago about green bonds being issued by the Treasury, but it's all gone very quiet. Is that still a viable option, or is it still on the table, or is it all died away?
It's happened. They had the first auction last week or 2 weeks ago.
Thank you.
Tim from Stafford. I was wondering, what would the impact be of rising interest rates on the investment big bank?
And could you pass the microphone to the lady next to you as well? We'll fit her into.
Hi, so I'm Kate Jennings from the Rail Industry Association. Dehenna name-checked transport. So my question is, you know, with the changes to things like PFI and PPP, what do you see as the role for private investment and private finance in transport, and maybe rail in particular?
Anthony Browne, I'll come to you first.
Can I just ask the guy with the blue tie? You said the role of impact of interest rate rises on
the investment big bank.
Right.
The investment big bank. Sorry, just confuse it.
Yeah. So green bonds, yes, it's happened, and there'll be more of it. So I don't know precisely what the impact of interest rate rises would be on the investment big bank. I mean, interest rate rises obviously make investment more expensive and tend to reduce the amount of investment, and that applies across the economy. And clearly that would be a concern. And interest rates are going to rise. There's no, with inflation where it's headed, there's no doubt about that. And on the question about PPP or PFI. And transport. I mean, PFI was structured in a way that often didn't leave particularly good value for the taxpayer, as to be said, over the longer term. I mean, it was an easy political fix when the government makes the decisions, and then we all end up paying the bills later. But we do need to look at other mechanisms of doing that. And the one that I mentioned earlier, I'll just bring it back again, about tax increment financing, because that applies to transport schemes. I mentioned the tube extension to Battersea Power Station, but I think that's a great way to get money in the future tax revenues, but actually you can package it up with private investment. It helps de-risk the private investment and makes it more interesting for investors that you have that other income stream from future tax revenues. And the reason, what I didn't say earlier about the reason why we're in the UK really quite bad at tax increment financing is because our tax system is almost entirely nationalised. There's very little local tax raising ability. So business rates they're collected by local authorities, but it's basically national tax. And so that would mean that every tax increment financing initiative would have to be passed by the Treasury, and the Treasury are experts at being cautious, is a polite way of putting it. They're very good at saying no to everything. In the US, tax is far more regionalised and localised. Individual states have their ability to raise taxes as well as municipal authorities, and so they can do their own tax increment financing schemes, and there's thousands of them across the US, often paying for infrastructure projects and some smaller things as well. But I think there's various, as I suggested in my Home article, various things the UK government government could do to make it more attractive, the UK regime more attractive to tax increment financing, so that transport companies, if you want to build a railway line or something, whatever, you could actually make a proposal to the government that you could fund it by this mechanism, and the government would have a regularised process for approving it or not, and that's what we need to get to.
Dehenna.
Thank you. I'll come to Tim to your question first. I mean, I can't really say much more than Anthony said, other than interest rates probably are going to rise. We don't want it, but we're going to have to see it happen. And yeah, it is going to make investing more expensive, which is not great. As you know, interest rates rise, more people will chuck money in a bank account, save it up, whatever it might be. So it is going to be difficult, and that's why we need to make sure that we're creating a decent environment to encourage this investment through kind of other means, either making it easier to invest or through other mechanisms making it actually cheaper to invest. On the point about transport, I mean, I think we definitely do need to see kind of more partnership work done here, because the state is not the answer to all of our problems, and the state certainly isn't always best equipped to deal with some of these problems. We do need to take proper expertise from industry and get some of those private investments in. And I think some of these areas where it's been really successful, not on transport, I apologise, but again is looking at Nissan, where the government put in about 10% of the funding, which was effectively sort of seed capital to draw in the rest of this investment from the private sector. I just think we need to be a lot more creative and a lot more inventive, particularly as we start looking towards the future of transport as well. As we look towards more electric transport, as we look towards hydrogen as a kind of possible mechanism. And also, there's even investment in incredible things like Hyperloop, which largely is going on in the private sector at the moment. And I'm really fascinated by the future of transport. And I think that really needs to be our opportunity to see that the state isn't always the answer, and to be more inventive about how we look at making that possible so that people can get from A to B.
And Mike.
Yeah, I think three great questions. Firstly, on green gilts, yes, it was done week before last. That issuance was massively oversubscribed. We put in an order, we got scaled right back. So again, our ask of the DMO and government would be more green gilts, please. Longer dated green gilts even linked to indexation to match our liabilities would be fantastic. So it's great that the inaugural one was done, but we definitely need more of it. I think around the impact of rising interest rates, there's an absolute inevitability that rates will rise. It's a question of when, not if. And, it's incumbent on the Bank of England, as with all other central banks globally, to tread the very delicate line by keeping economies on the support that quantitative easing and low rates provides them, but not letting inflation run away. As I mentioned previously, we are an investor over the very long term. We invest through all market cycles, which is why we take a long-term view. So we try and dampen out some of the impacts of investing. And I completely agree with Anthony's point earlier about investors, such as the city fund managers, I think you referred to them as, they do need to move to a more long-term view. And that's the view that Phoenix Group takes. We invest. We're a very simple business. We help people save for their retirement, to accrue a pension pot such that when they retire, they've got a decent amount of money that they can then have an income. And when they're in retirement, we pay them an income. So we invest over the very long term, and that really affords us to invest in all market cycles. As it relates to transport, completely agree. We have a significant demand to invest in local transport to provide the debt financing that's required to build that transport. We also want to help build the latest technology. So we were delighted to invest in Alstom's trains factory in Derbyshire, which we also did earlier this year. Some of my colleagues a few weeks ago got to go up and visit the train factory. I was really gutted that I didn't, but I didn't make the invite list. But again, we want to do more of that type of thing because it creates jobs, it creates long-term economic growth, and we're investing in regions where our 14 million policyholders live in.
Now, I know our speakers are in great demand, so we've probably got time for one more round of questions. The gentleman here at the front and the gentleman with the beard, please.
It does work. It's mostly a question to Phoenix Group, but I think it has government implications. You have a responsibility for providing pensions and good income after retirement. And I just wondered, what percentage of your long-term, what percentage of your portfolio is in long-term investment. And I just realized I didn't say who I am. Don Williams, Hampstead and Kilburn, and I used to work for Aviva Investors, so my questions might be a little bit more pointed. I'm sorry. You talk a lot about regional investments and good examples, but what are the obstacles, the impediments that stop you for investing, and similar companies like yours are investing in the long term, 10, 20, 30 years? And what could government or MPs sitting around the table right now who want your investment, what could they do to make a better policy environment as well as a better regulatory environment, which would give opportunities to invest more in the different regions?
Thank you very much. And our other final questioner.
Hello, Joel Fuller-Thompson. So, as a project of an engineering apprenticeship and advanced apprenticeship, how do you think you would transform the view of the usual school to university to work, to going from school into an apprenticeship or an advanced apprenticeship, which would help, it would help level up our younger workforce whilst helping to reduce university loan debt? Do you think that the increase of the engineering institutes within schools would help this?
Thank you both. Mike, let's come to you on this.
Yeah, great question, both questions. And Don, thank you for your question. You're absolutely right. It was pointed. It was coming from a fund manager veteran. I think you asked two questions. One around the proportion of our assets that are long-term, that are invested in the long term. The vast majority of our assets are invested over the long term. And I'll be very specific. So of the assets that we've originated this year, and some of what I'm spoken about, like Nissan, like Alstom and others, they had, and just indulge me for a moment, they had a weighted average life this year of about 17 to 18 years. But that meant that some of them were really long dated, like 30 years, and some of them were much shorter dated, like 10 years. Our appetite when we talk to investors is for as long dated as possible, because again, we manage people's pensions in the accrual stage up to retirement. That can be 30 or 40 years, so we take that time horizon. And when they retire, we also have to pay them an income over the remainder of their life. So again, we take that very long-term time horizon. I think, look, on regional investment, we've had some great successes this year, working with companies who are based in the regions, but also working with local authorities and housing associations. And we absolutely want to do more of that. And we very much welcome the government's review of the Solvency II rule set to make it more fit for purpose for the UK as the UK is out of the EU, but absolutely having the customer protection at its core. And I think this presents a really unique opportunity for that insurance regulatory rule set to be fit for purpose, so to allow us to invest over the very long term to meet our customer needs, but also to harvest some of the societal benefits that come about from making long-term investments in regional economies.
Anthony.
Yeah. So on the regional investing question first, so a common answer to this is enterprise zones. And I was involved when I worked for Boris when he was mayor. I was involved in setting up an enterprise zone in the Docklands. And the trouble with enterprise zones generally is that they're not ambitious enough and they don't provide enough benefits for investors, and they're too short term. So they wouldn't encourage. And the tax regime that George Osborne brought in when he was Chancellor for enterprise zones was actually giving tax breaks on business rates for companies that move jobs there rather than existing companies that are already there that might grow and take on staff. So I actually think, and this comes to the whole levelling up agenda, I look forward to what how he defines levelling up and what the solution is. But I was, again, I had a responsibility in London for the European Regional Development Funds, which actually London bizarrely got, despite the fact it was very wealthy. The EU has this is one area where I'd say that I think we have something to learn from the EU, that actually in terms of their regional development funds, they look at the areas that have a certain percentage of national GDP or European average GDP, and if they're below a certain level, they'll target funds there. I don't particularly want to target funds as such there for the similar reason that Dehenna would say, but you could target tax breaks. So, for example, you could say that any local authority area of the country that's got less than 80% of national GDP, that actually they get 100% rebate on business rates, for example, to existing companies and new companies that move jobs there, and you guarantee it for 20 years or something like that. Or you have to work out the cost of it. Maybe it's a 50% deduction. Maybe you only do it for those parts of the country that are less than 75% of GDP. But actually, it's a way of encouraging investment in certain areas that would level up. And you can also target, to the extent we do infrastructure spending and so on, you can also target at those areas. On the engineering question, the engineering apprenticeship question, I know Dehenna has sort of big interest in this. I fundamentally agree that we and the government does, that you need a proper trajectory for a career and educational trajectory for people with technical skills, and we haven't been good at that in this country, and there's been various attempts over the years to do it. Apprenticeships is obviously one thing, and the government's investing heavily in that. There's technical colleges, there's T-levels that are coming up, but absolutely we need to make sure that people who don't want to go down the sort of hardcore academic route and build up the university debts you mentioned, that they have a proper career trajectory, and I know that that's something the government has been focusing on, but will be pushing an awful lot more.
Thank you. Dehenna.
Well, I'm going to talk exclusively about apprenticeships because I think they are absolutely fabulous, and congratulations you for getting through 2 of them, which is very impressive indeed. I think apprenticeships are blooming incredible, frankly, and not enough is made of what a genuinely important and reputable kind of path this is for people to take. I know when I was at school and I was sort of trying to decide what I wanted to do with my life, and we were given advice, my school, it was a private school, so perhaps it had a slightly skewed view, but it was, well, you'll do your A-levels and then you'll go to university and then you'll get a job. And that's the approach that I sort of wanted to take from being a kid. I thought I wanted to go to uni and experience that anyway. But if I'd been taught about apprenticeships and, the kind of opportunities that I could have had through doing a really good quality apprenticeship, finishing with a decent qualification with actual skills rather than just a piece of paper with a degree on, which I loved my degree, don't get me wrong, but it's not been particularly useful despite being a politics degree even in my current career. If I'd had that opportunity really kind of advertised to me, then I probably would have considered it, particularly if people then tie it into degree apprenticeships, where you can go through that full training process, have the skills, and yet not have the blooming debt left behind as well. You guys are earning as you're learning, and I think it's great. And I would be absolutely slated when I go home if I don't praise the excellent work of Learning Curve Group, who are based in Spennymoor in my own constituency, who support literally tens of thousands of apprentices right around the country. They are incredible. I get involved with them to promote the value of apprenticeships. During apprenticeship week, we're going to do some stuff. It's all super exciting, and I try and spread the good word about apprenticeships as much as I can. But I think we as a party actually still need to get a little bit better at doing this too.
We do actually have the Universities Minister at our next event here in the Marquee at 1:00, if you'd be interested in further discussions on that topic. It just falls to me now, ladies and gentlemen, really to say thank you to all of you for coming, for your fantastic questions, and for joining us for this really fascinating debate. Thank you to, obviously in his absence now, to Steve Barclay, who've been so generous with his time. Thank you to our other panellists, Dehenna Davison, Browne, Mike Eakin, and thank you to the Phoenix Group for partnering with ConservativeHome on what I hope you agree has been a really interesting discussion. Thank you to all those who've tuned in from home. Anyone who wants to look back on this discussion, rewatch it, it'll stay on the ConservativeHome YouTube channel as well. But please join me in a big round of applause for our panellists.